By 1916, 3 years after the law passed, families across the rural Midwest were selling land they had farmed for 2 generations at prices they had no power to negotiate, to buyers who understood exactly why the sellers had no choice. The transactions were legal. They were recorded in county deed books the same way every other property transfer was recorded, with the names of the parties, the parcel description, the consideration paid, and the signature of the notary who witnessed the exchange. What the deed books do not record is the pressure that produced the transaction, the letter that arrived in the spring informing the family that their tax assessment had been recalculated under the new federal framework, that the amount now owed exceeded what the farm generated in a good year, that payment was due before the harvest, and that the property would be subject to seizure if the obligation was not met. Thousands of families received versions of that letter. Thousands of families sold. The buyers were not always strangers. Sometimes they were neighbors who had more capital, or banks that had been positioning for exactly this kind of distressed sale opportunity since the law was being debated in Congress, or land consolidation companies that had been incorporated in the months immediately following passage specifically to acquire the properties that the new tax structure would force onto the market. 3 years. That is how long it took for a single piece of federal legislation to restructure who owned the land in significant portions of rural America. And the restructuring happened so fast and so quietly that the families it displaced had no framework for understanding what had hit them. The Federal Reserve Act was signed into law by Woodrow Wilson on December 23, 1913. It created the Federal Reserve System, a network of 12 regional reserve banks operating under a central board in Washington, authorized to issue currency, set interest rates, and regulate the money supply in ways that no previous American financial institution had possessed. The stated purpose of the legislation was to stabilize the banking system, which had been subject to periodic panics. 1873, 1893, 1907, that contracted credit, collapsed businesses, and produced economic suffering that the existing decentralized banking structure had no mechanism to prevent or contain. The Panic of 1907 had been severe enough that J.P. Morgan personally organized the private financial response that prevented a complete systemic collapse, and the spectacle of a private banker serving as the de facto central bank of the United States had generated enough political pressure that Congress was finally willing to create a formal alternative. The Federal Reserve Act was the result of 6 years of legislative work, intense lobbying from both banking interests and reform advocates, and a political compromise that satisfied nobody completely and gave the banking industry more structural influence over the new system than the reformers had wanted. Wilson signed it on December 23rd because Congress wanted to finish before the Christmas recess. Most Americans learned about it from a brief newspaper notice and went back to whatever they had been doing. The families who would be selling their farms 3 years later had no way to know yet that the law had anything to do with them. What the Federal Reserve Act did to property ownership in rural America operated through a mechanism that was not in the text of the legislation and was not discussed in the congressional debates that preceded its passage. The mechanism was interest rate control, and its effect on agricultural communities worked through a chain of consequences that took several years to become visible, but that economists who were paying attention in 1913 and 1914 identified early enough that the warnings exist in the record, filed in the same places where nobody looked until the damage was done. The chain worked like this. Before the Federal Reserve, credit in rural America flowed primarily through local and regional banks that made lending decisions based on their knowledge of local conditions, local borrowers, and local land values. The interest rates those banks charged were high by modern standards. Agricultural loans in the pre-Federal Reserve period typically ran between 6 and 10%, but they were set in relationship to the actual economic conditions of the communities the banks served. And the banks had a direct stake in the economic health of those communities because their deposits came from the same farmers and merchants who were borrowing from them. The relationship between a rural bank and its borrowers was not warm or equitable by any modern standard, but it was local in a way that gave borrowers some practical leverage because a bank that foreclosed aggressively on its farming community destroyed its own deposit base in the process. That constraint did not eliminate predatory lending, it moderated it. The Federal Reserve introduced a centralized mechanism for setting the discount rate, the rate at which reserve banks lent to member commercial banks, which then set their own lending rates in relationship to the discount rate. When the Federal Reserve raised the discount rate, borrowing costs for commercial banks rose, and those costs were passed to customers. When it lowered the discount rate, credit became cheaper and more available. The intent was to use this mechanism counter-cyclically, loosening credit during downturns to stimulate economic activity, tightening it during periods of inflation to prevent overheating. In the agricultural communities of the Midwest and South, the mechanism produced effects that the countercyclical theory did not predict, because agricultural credit operated on a different cycle than urban commercial credit, and decisions made in Washington, based on the aggregate condition of the national economy, did not map cleanly onto the specific situation of a wheat farmer in Kansas or a cotton farmer in Mississippi whose income arrived once a year, whose expenses ran continuously, and whose ability to service debt depended entirely on crop prices that the Federal Reserve had no mechanism to stabilize. When the Federal Reserve tightened credit in 1919 and 1920 in response to post-World War I inflation, it did so into an agricultural economy that had expanded its planted acreage and its debt load significantly during the war years in response to government encouragement and strong wartime commodity prices. The credit tightening hit farmers who had borrowed to expand during the boom, while commodity prices collapsed with the return of European agricultural production after the war. Between 1920 and 1923, farmland values in the Midwest fell by 30 to 40%. Foreclosure rates reached levels that would not be exceeded until the Great Depression. Hundreds of thousands of families lost land that had been in their possession since the Homestead era. The specific mechanism connecting the Federal Reserve Act of 1913 to the farm crisis of the early 1920s was documented by contemporary agricultural economists who testified before Congress during the crisis and who identified the credit contraction of 1919 to 1920 as the proximate cause of the collapse. Their testimony is in the congressional record. The Federal Reserve Board, in its own annual reports from the period, acknowledged that agricultural credit conditions had deteriorated severely, attributed the deterioration primarily to falling commodity prices rather than to interest rate policy, and recommended patience. The families selling their land at distressed prices did not have the luxury of patience, and the buyers acquiring that land at those prices did not need it. The redistribution of agricultural land ownership that occurred between 1920 and 1940, accelerated first by the post-war credit contraction and then compounded by the Depression and the Dust Bowl, constitutes one of the largest involuntary transfers of property in American history, and it has no single event attached to it that serves as a legible historical marker the way that a battle or a legislation signing does. It happened in county deed books, in foreclosure proceedings, in the quiet arithmetic of families, calculating whether they could hold on one more season, or whether the bank's offer was better than waiting for the sheriff. The families that lost land during this period were not primarily the very poor, who had never owned land to lose. They were the middle tier of rural America, families that had acquired land through homesteading, through inheritance, through decades of careful accumulation. And the loss of that land moved them permanently out of the landowning class in a country where land ownership had been the primary mechanism of intergenerational wealth transfer since the colonial period. The children of those families grew up without land. Their children grew up without land. The chain of ownership that had been building since the mid-19th century broke in the early 20th and did not resume, because once land consolidates into larger holdings, it does not spontaneously redistribute. It stays consolidated. The Federal Reserve Act did not cause all of this alone. Commodity price collapse, drought, the structural vulnerabilities of single-crop agriculture, the consolidation tendencies of industrial-scale farming, all of these contributed to the same outcome. What the Federal Reserve Act did was remove the local constraint on credit that had given rural borrowers some practical leverage in their relationship with lenders, replace it with a centralized mechanism that operated on a national logic indifferent to local conditions, and do so in 1913. 6 years before a credit tightening that hit agricultural communities with a force that the decentralized pre-Federal Reserve System might not have produced at the same scale or the same speed. Whether the architects of the legislation understood this consequence and accepted it, or whether they genuinely did not predict it, is a question the historical record does not resolve cleanly. The congressional debates include warnings from agricultural state representatives about exactly the vulnerability the law created. Those warnings were noted, addressed with reassurances about the Federal Reserve's commitment to serving all sectors of the economy, and outvoted. The deed books from the farm crisis years are in county courthouses across the Midwest and South. The foreclosure records are there. The distressed sale transactions from 1920 to 1923 and again from 1930 to 1940 are recorded in the same format as every other property transfer, with nothing in the document to indicate that the seller had any less choice than in any other transaction. The pressure that produced the sale is not in the deed. It is in the letters that preceded it, the bank notices and tax assessments and payment demands that arrived in rural mailboxes and generated decisions that families understood at the time as the worst outcome of their lives. Some of those letters survive in family papers. Most do not, because families that lost their farms in this period were not in a position to maintain careful archives. The land is still there. The names in the deed books changed. That is what the record shows, and that is enough to see what happened, if you know which years to look at and why the names changed when they did. If something in this video stopped you, the buyers who incorporated specifically to acquire distressed land, the congressional warnings that were outvoted, the deed books, where the pressure is invisible in the document, but visible in the pattern, tell us which moment in the comments. Not a general response. The specific thing that made you stop. This community has people whose family histories ran directly through this period, and those threads in the comments carry information that no video can hold. If your family lost land in this era, or if you have found a property transfer in your genealogy research that now makes a different kind of sense after watching this, bring it here. We want to know what you found. Subscribe if you want to be in this conversation when we go deeper. We are going deeper.